Okay, Steve, I'm going to make you a panelist. And I'm waiting to hear your voice.
All right, so I'm unmuted.
You're good, Steve. How are you?
Very well. So I'm
Happy New Year to
ready
you.
to roll.
I had the pandemic flu that they had here in the U.S. At our last attempt. I'm so glad that you came back. I'm showing your screen for Patreon right here. And just a quick introduction. Steve Keen's a professor at Kingston University, and his fame and his well-known status came from his book, Debunking Economics, and Steve was aware of what was coming in 2008, the Great Recession that wasn't so great for millions of people. And he has a mission to bring about a change on the way people look at the economy. And anytime you're trying to make a change of a system that is well entrenched, it's not an easy battle. So I congratulate you on fighting the good fight, Steve. Welcome to F.A.C.E.
Thank you.
So we have a lot to delve into, and we talked about a few things you want to cover. We may as well start with the Fed's been tightening. Now they're going to be talking about rolling off their balance sheet here, and the ending of QE mainly happening here in the U.S. When do you think Draghi in Europe's going to get on board, and what Japan did that took the yen higher this week is at the beginning of that happening in Japan and China? Do you think that globally all central banks will be in sync coming off QE?
Oh, most of the ones that are doing it will be trying to unwind it this year, and I think are going to find themselves winding it right back up again afterwards. I've always called QE a pact with the devil, and the reason for it is that it's part of the motivation for it came out of the model of money creation, which economists get drummed into their heads by university textbooks, called the money multiplier model, and that argues that if you create excess reserves in the banking system, that will then mean the banking system can create 10 times as much money as you add excess reserves. It's total nonsense because, in fact, banks cannot lend out reserves. If you look at the accounting behind it, it violates the rules of accounting to imagine that you can lend your assets out and create more liabilities in doing that, which is what is actually involved when you create a loan. You increase your assets by creating a loan as a bank. You increase your liabilities because you put that money in someone's bank account. That, of course, is then a liability of the bank. So it involves an increase in assets, not a decrease in assets. But to talk about creating money by lending out reserves means somehow you're going to reduce reserves and increase lending. Now, there are some circumlocuitous ways that it vaguely can be done, but fundamentally that's a wrong model of banking. So that was one major motivation for it.
Okay, so do you believe that we're in the final stages of the fractional reserve banking system that we have?
No, I don't, for a simple reason: it doesn't exist. This is one thing which is very frustrating for me, trying to communicate these ideas, because people are often pro or against something which doesn't actually exist. It's an economic model they learned in textbooks at school or university, but it's a fallacious model. So fractional reserve banking implies that banks lend out their reserves. They don't. And this is, I try to get people that they're trying to understand this, to draw up a basic accounting table, put assets on one side, liabilities on the other, and equity is the gap between the two. And fractional reserve banking implies that a bank has to wait for a depositor to put money in, which increases their liabilities, increases their reserves as well. And because they both go up by an equal amount, they're supposed to have excess reserves, which they then lend out. That means deducting something from your assets. If you deduct from your assets, you either deduct also from your liabilities or your equity. It's not a way of creating money at all.
Okay, so Steve, it's always been our contention here that the Fed was raising rates so they'd have a cushion if there was ever a need to be able to take them down again. You can't take them down from zero. Is that your view? Is that the tightening that's going on is just so central banks can attempt what they did in 08 again if need be?
No.
No? Okay.
No, I mean, again, you have to realize what you're dealing with here, and that is you're dealing with a bunch of economists who've been trained in a completely fallacious but superficially convincing theory of how capitalism functions. So what they're actually doing is they're applying their model. And the model that dominates mainstream economics these days, even after its catastrophic failure to warn of the financial crisis back in 2007-8, are called dynamic stochastic general equilibrium models, DSGE. Sounds fancy. It's a very fancy word for a very clunky way of modeling the economy. But an essential part of that clunky way of modeling the economy is they treat the financial sector as an echo of what's happening in the real economy. So they say that the financial sector simply intermediates what's needed by the real economy. And you can therefore build these so-called sophisticated models with no element in them explaining the banking sector or let alone debt or money themselves. So they completely leave this stuff out of the system. When you boil it down, they're very complicated models, but you can actually boil it down to three numbers, 2, 3, and 4. And what's hardwired into most of these models is, first of all, the belief that the rate of inflation should be 2%, the rate of real economic growth should be 3%, and the reserve rate of interest should be 4%. So what they're doing now is they think they've been through a huge crisis. They're now coming out of it. Thank God, for some reason it's ended. They didn't know why it started. They don't know why it's ended, but they think it's over. So they're heading back to those 2, 3, 4 numbers again. And that's what's really driving their behavior. Now, in the real world, of course, that model bears no resemblance to the real world. So they'll be forced to go into reverse before they get anywhere near those numbers.
Okay. What do you think is going to be the catalyst for asset prices to fall across the board? I mean, there's so many bubbles to choose from.
Yeah.
Probably the biggest would be sovereign debt across the globe, corporate debt. The bond market is much larger than equity markets combined. Do you think that's where it starts, that it will be an unexpected rise in long-term yields that are the catalyst for people to say, well, these valuations were crazy when rates were lower and they're really crazy now, and start to liquidate assets?
No, sorry, I don't. The 2 points that I see the bubbles reversing, the reversal of QE,
okay,
because that's actually driven a large part of the asset price bubble, and then also the level of private debt that's been accumulated, household plus corporate debt. That's far more important than sovereign debt. And
okay.
in fact, that's also far higher than people realise at the moment.
Are households more leveraged than they were at the highs in 07?
No, they're lower. They've got a lower level of leverage, but it's still a high level of leverage than has applied in history before the Great Depression. Okay. So if you take a look at the data for America, for example, I'll bring that up. If you can actually hand over control of the screen to my computer for a tick, I'll show you something which would be useful.
I'm going to make you the presenter.
Can you do that?
Yep.
Okay, now I'm looking at, okay, so show my screen. Yep, okay. So that's the web page of my not well developed as yet, Prof. Steve Keen web page, which I'm moving to from Debunking Economics. But this shows the data for the levels of private and government debt around the world from 2016. I haven't got it set up as yet with a database that updates dynamically, but I'll simply show you the data for the USA, which, pardon me, I've gone slightly past my screen here. So if you want to see this, I'll just actually highlight that's the URL there, Prof. Steve Keen / ridiculous long data on credit and employment and house prices. But if you go there for each country, you'll see that I've got the data for them taken from the Bank of International Settlements. Now, the red line there is the one that everybody obsesses about. That's government debt. The blue line is the one that matters,
wow,
which is the level of private debt. And you can see that peaked at about 170% of GDP immediately after the financial crisis, fell to about 150%, is now rising once more. Now, if you look at that and say, what's that doing to demand? My metric on demand is that, pardon me, again, I've jumped too far. Demand is a combination of the turnover of existing money plus credit. Now, we don't actually measure.
Is that like
a velocity? Velocity of money times the money stock, okay, which we don't actually measure properly these days, plus credit.
Okay.
Now, we don't actually have an accurate measure of the velocity, but if you look at the figures that I've got there for GDP and GDP plus credit, there's some double counting involved in that, because some credit is used to buy goods and services, but about 80% or more of credit is used to buy assets. So if you look at the data, that takes us from 1950 right through to 2016. And you can see with the black line, which is graphed against the right-hand axis, credit, which is the annual change in debt, was always pretty much above 5% of GDP, except for a little dip back in the 1990s, hitting 15% of GDP when the crisis began. And the crisis began because credit went from plus 15% to minus 6%. That's your cause of the crisis. Now, since then, you've now had a revival of credit-based demand, but because, just to go back up on screen, because you've got such a high level of debt already, you're sort of close to the Mount Everest level for the American economy in terms of its capacity to cope with carrying private debt. So any revival that's going to happen from here up will not take you, it may not even take you back to this peak level of debt of 1.7 times. Maybe it might make it past to 1.8 times GDP, but it's not going to rise like it did from, back in the 1950s, from 50% to 170%. So credit-based demand will never be strong again. And that's what the Federal Reserve and co simply aren't aware of.
As a chart, I'm wondering, maybe you could turn your volume down, because I'm hearing the background.
Yeah, I'll turn it down.
Looking at the charts that you're showing, so I think it's in the webinar that's making it echo. But all these look like are retracements, like the black line has come halfway back. Would it be more negative if we just start rolling over from here, and is that possible?
Well, it's what's actually happened in the case of Japan, and that's what I see as the canary in the coal mine. We should have taken notice of something like 30, 40 years ago. If you look at Japan, I think Japan pre-tells the history that we're all going to live, because it's been through this from 1990 on. So here's Japan's data. You can see Japan's private debt level peaked at 220% of GDP. It's then been coming down. It's coming down as public debt rises, because public debt compensates for the fall in private debt. And what they've been through, and this is now, look at the black line here for Japan, credit, when their crisis began, peaked at 28% of GDP. It then fell to minus 12%, which is why they had such a huge slump. But since the late 1990s, credit has either been negative or barely positive. And that's been going on for 20-something years. So we're retracing the same basic dynamic. Now they're finally back in a period of moderately sustained credit growth. But what happens is not a retracing. They tend to stay at this very high level of private debt. And you can see, even though it's fallen substantially from the peak they had back in 1990, it's flatlining at about 160%, and it's been there for ages. Now, if you go back to before their bubble began, because Japan had what they actually literally called the bubble economy from 1980 to 1990, the bubble economy began with a debt level of 1.4 times GDP, rose to 2.2 times. Even with all the deflation, still the decline in debt since the peak, they're still not back to the level they had back in the 1970s. So what that means is it's like you got to, in fact, you can regard a level of private debt as being like an anchor around your ankles when you've been asked to run the 100 meters. The bigger the anchor is, the slower you're going to do the 100 meters. The less credit-based demand it is, the more sluggish your economy is going to be. Of course, we know Japan's been in that situation for 25 years. The US and UK have entered that position after the 2008 crisis.
Okay. So what's on the horizon? Do you think things begin to unwind in 18, or are they going to have the ability to keep all these balls in the air for a few more years, maybe into 2020? Is there any time element that someone like you can see whether something is becoming acute or it's just still chronic for a while?
It's time and location, Dale, because in terms of location, I would rule out the United States, the UK, any country that had a big crisis back in 2008 as a site for a future major crisis in the immediate future, because with that level of private debt they've already accumulated and the low level of credit growth after the bubble, you're not going to see huge growth in credit subsequently. And because you won't see huge growth in credit, you won't see much of a fall in credit either. So to show you the example of the data for the USA again, let's go back and take a look at it. what you can see there is credit demand was running at averaging about 8 to 10% of GDP all the way through from 1950 till the crisis. Since the crisis, it turns negative for the first time since the Great Depression. Now it's sort of topping out at about 7% of GDP. Now you can see you trace back for most of the time, except back in the 1990s recession, credit's been above that level. So what you have is fairly anemic demand from credit. So if it falls, say, from here, it's plus 6 or 7%, even down to the deficit reached of minus 6% back in 2010, it's not as big a fall as it was for 2008, 2010 itself. So I call the United States, the UK, Spain, most of Europe, the walking dead of debt. They've had their crisis, they've been turned into zombies. Zombies don't have an exciting sex life, so they're not going to be the ones who are going to see it. But if you go to other countries which managed to avoid the crisis by continuing to borrow money, say, for example, Canada, then what you can see is its debt level was 170% of GDP roughly when the crisis hit. It's now 220% of GDP, far higher than America. If you then take a look at what's happening with their credit levels, they're talking substantial levels of credit. They are going to have a downturn when they are now starting to reach peak credit. And so it's the countries that avoided the crisis by borrowing more money that are going to have it. Obviously, I see Canada as one. The same for Australia. Here's Australia. It was 1.8 times GDP. Right. Now it's 2.1. You take a look at this. Is all the data is slightly out of date, by the way. I don't have an up-to-date set of charts on my website, but I do have that on my computer. I could actually bring it up if anybody asks.
You know, these are you know, the currencies are, I call them commodity-related currencies.
No, that's true.
Do you think that perhaps a bull or bear market in, say, oil for Canada and iron ore and other metals from Australia will suffer during this time frame, that prices will be under pressure? Or could a bull market in commodities soften the blow for Canada?
The bull market would soften the blow for them because that's a major reason why Australia and Canada got through the crisis so well. They both had housing bubbles which didn't burst. Australia re-inflated its bubble. But what kept them going, of course, is enormous demand from China. So if you look at the Chinese economy, and again, that is now, I mean, Chinese data is rather hard to trust, but you can see China went from 1.2 times GDP to almost 2. That's the fastest rate of growth of private debt in the history of capitalism. And that's what's...
this has got to be where the black swan is going to land.
You take a look at this, is again the same comparative chart. So you can see that in 2010, credit was almost 40% of GDP in terms of its scale of demand. And but what China can do, the Western countries can't do, is very rapidly flip over to government spending. So if you look at the level of government financing during the crisis in America in 2008, the so-called Obama stimulus maxed out at about 10% of GDP. I've seen some people claiming that China's current level of net government spending is 15% of GDP. And a good friend of mine who works in very large-scale infrastructure says that's an understatement. So the scale of government spending can attenuate the downturn in private credit. So China will have a credit crunch, it has to have it, but it can be attenuated much more rapidly than it will be by countries like Australia or Canada, or actually in that case, South Korea. I'll quickly show you Korea's data here as well. Again, remember, this is about a year out of date, but Korea also borrowed its way through the bubble. It's also got high levels of credit, which are now turning down. So I expect the crunch to occur not in the US and UK and Europe, but in just go through in terms of scale, China with the attenuation of its government spending, Canada, South Korea, Australia, and then a range of unlikely countries, but rather smaller ones, Belgium, Norway, Sweden, Singapore, and so on.
Okay. So do you have any view on what's going to be a store of value in this? Is it going to be flight to quality back to the US dollar? Could it be gold? And I know everyone has to talk about it. You call them those bloody cryptos. Maybe we should make a shift there, Steve, and tell us what your view is, and would they fit into your new model that you're working on?
Yeah, well, I think Like for start, the usual story that happens whenever there's a downturn in any other country, everybody rushes back to the American dollar.
Okay.
So I expect to see a crunch for several major countries, not on the scale of America, of course, but Canada, South Korea, Australia, the three larger economies are going to have a slump. Also Belgium, which means you're going to have some worries with the euro, Norway, Sweden, Singapore, and of course the fund managers in those countries will pull out of the local currency and buy into the dollar in response.
So if really the U.S. isn't going to be, we've already had our crisis, and perhaps we're going to become zombies. What's going to force the Fed to reverse course on QE? Just a fall in the stock market, or trying to pay lower interest rates when demand is slowing in the Treasury market?
Yeah,
what's going to be the catalyst?
Well, let's go through what QE actually did, because there's a lot of myths about QE itself. But look in the American economy, QE was running at about $80 billion a month, which is roughly $1 trillion a year. Now, for a start, let's just let one thing nice and clear using that example. Did you see QE mentioned on your tax returns in the last few years? Of course not. Okay, the money was created.
I have a copy machine, but my counterfeiting skills are.
It's just basically the double entry bookkeeping. They say we're putting $1 trillion into the bank accounts of banks and non-bank financial institutions. They're giving us $1 trillion worth of bonds. So it's simply double entry bookkeeping that creates the money. But the whole idea was to drive banks and non-bank financial institutions out of government bonds and also out of mortgage-backed securities as well. And therefore what happens is think about it in terms of a cash transfer. They get $1 trillion of cash from the government. The government gets $1 trillion worth of bonds from them. That means they have $1 trillion less worth of income earning assets, $1 trillion more of cash. So therefore, let's imagine they spend the whole $1 trillion in the share market, which is not going to be too far from the truth. That $1 trillion drives up the value, and let's again just say it's a straight transfer, drives up the value of shares by $1 trillion. People with shares sell them for $1 trillion profit. They then might spend, say, $900 billion of that back into the stock market again, put about $100 billion into buying goods and services in the economy, a couple of extra Lamborghinis, the odd yacht, people to clean them for you. That gives you a trivial stimulus for the scale of the money you've pumped into the economy, but it does cause a boost. But the main thing it does is boost asset prices. Now, of course, if the central banks decide to unwind QE, then the whole process goes in reverse. If they tried to sell $1 trillion worth of bonds to the financial institutions, they would do the buying, but to buy it, they'd need to raise the cash. To raise the cash, they'd sell the shares. To sell the shares, the share prices will fall. As soon as that happens, the central banks will panic and go back in reverse again.
Okay, I have a question from the community. Do you have any idea, Steve, how much private consumer debt has flowed into cryptocurrencies since you can fund accounts with credit cards? And if cryptos collapse, does private debt collapse with it?
Yeah, well, this is one of the, there's no real idea of how much money people have borrowed to buy cryptocurrencies, but I've seen comments, and particularly this is actually intriguing because you would have seen in the last day or two, South Korea has banned trading in cryptocurrencies. Again, one of these things I saw on the web, so you take it with a grain of salt, but about 1/3 of Korea's industrial workers have, inverted commas, invested in Bitcoin, and a lot of them have done it by extending their mortgages. Now, of course, they're doing it. They think there's a nice, cheap way to pay the mortgage. Crypto is going through the roof. There's not much inflation going on with the fiat currencies. We can make a profit that way. If cryptos crash, pardon me, if they're geared to a factor of 3 or 4, they get wiped out. So a fall in crypto can cause bankruptcies in the credit-based money and feed back into crypto again, because people will try to liquidate what they think is liquid, being cryptocurrencies, to pay their ways out of debts they have to pay back to the banks, and both could fall with each other.
Wow, Steve, what a great interview. I know that you just wanted to make a statement, and I've gone to your website and I see how you have to deal with the public sometimes, and people get very emotional, and sometimes you could be emotional about economics, but you can always be civil and agree to disagree. So I know what happens sometimes. You have to block people, right? And Yeah, I'd like to just ask you, the neoclassicals are going to limit the debate. Is it because they have control of the media, or is just all the strong lobbies and international corporations like the game the way it is, and that's why they're going to limit the debate, and you're going to really have to get out there on the front lines to get your ideas across, and that'll bring me to Patreon and how people could support your work.
It's more a religion. This is what I'm actually bringing up. If you can see, I'm playing with my screen right now. I want to show you some stuff from the neoclassicals, because what I'm really challenging is a religious sect. And this is not a outright criticism of economics, because in my opinion, this scientists and religious fanatics have something very in common. They actually believe they know how the world operates. The difference between the two is one tests their theories with data, and the other one just goes back and reads the good book and says this is what the Bible or what the Quran says, so it has to happen. But if you look at what's been done by mainstream economists, they have built almost a religious belief about how the economy operates. And I'm challenging it by saying, look, it's a fallacious theory. In the sense, my favorite analogy for neoclassical theory versus what I'm trying to bring about, and I'm not the only one, of course, there's a range of non-orthodox economists as well. I've just got the biggest voice amongst them, is that we're like Copernican astronomers challenging the Ptolemaic astronomers.
Right.
With us saying that the universe is centered on the sun, and they're saying the universe is centered on the earth. And in fact, you can make a model in both cases which fits the data. And in fact, the Ptolemaic model with the earth at the center and the sun and the moon and the planets and stars orbiting around it was more accurate than Copernicus's model when Copernicus came up with it. But of course, it was completely wrong about the structure of the universe. Now, a similar thing applies now. And what has happened is neoclassicals were completely flummoxed. Their model fitted the data perfectly because, of course, they overfitted the data to the past, completely failed to predict the future because they don't even include the major driving forces, which, in my opinion, the private credit system. They leave that out of the models completely. So they had zero capacity to predict the future in 2008. Now they're trying to rebuild themselves and say we can get it all fixed up by using our existing models. So this is just recently, the Oxford Review of Economic Policy published a brand new set of papers, and I urge people to download them and take a look at them, by the way, which you can do for free until the middle of February from the Oxford Review of Economic Policy. And you'll see that's what they think the economy is about. Now, all you have to do is read a few of the papers to see effectively from a realist, a real world perspective, these guys are off with the fairies. But they're defending their turf because this is their religion.
Understand. They're apologists.
Oh, they don't even know they're apologists. They actually believe they know the truth.
Okay. All right. So, Steve, really an amazing conversation I'd have with you. And how can people that are hearing us live now and that will see the video later become part of your movement to, well, make this economy fairer for everybody?
Yeah, I'm trying to make us. I'm not a revolutionary. I'm not an apologist either. My perspective on capitalism is there's no point campaigning to change it if you don't understand it in the first place. So I'm trying to build realistic models of capitalism, building on the work of a whole range of non-orthodox economists, including people as diverse as, to some extent, some parts of the Austrians, Joseph Schumpeter, Hyman Minsky, a guy called Goodman, most of you wouldn't have heard of, John Blatt, another one you wouldn't have heard of. I take some ideas from Karl Marx and I take them from Quenet and Cantillon and so on. So I'm trying to pull a realistic approach to economic theory. And I've given up on universities as a place to do that because effectively the religious neoclassical mob have taken over the major universities, Oxfords, Cambridges, MITs and so on. And characters like me only get to teach at low-ranked universities. And we just don't get to reach the good students, and we don't necessarily get the critical voice we need in the university sector. So I'm going public. I'm the first economist to be successfully crowdfunded. I'm one of two. Richard Wolff is another, through Patreon. I hope you can see my Patreon page right now.
Got it.
And that's where I put most of my posts through right now. I've got a nice community there, about 800 and coming up to 850 people. And that's enabling me to continue acting as a independent public intellectual and to challenge the basically fallacious orthodoxies of both the left and the right on economic theory.
Well, Steve, you know, I would say I'd love you to replace John Carney at the BOE, but if you had your way, there probably wouldn't be a BOE.
No, I've actually, we need a central bank. Central banks are clearing houses for private banks.
All right, well then Steve King for chairman of the BOE is what I say.
I'll hold my breath on that one, mate. Actually, I won't hold my breath.
Well, you know, thank you so much for your time, Steve. I encourage people to go to Patreon and read about Steve's views and keep in touch. Steve, I'm sure you're going to be, as things begin to unfold and QE begins to take effect on the different asset classes, this is going to be a good place to see all your posts, correct?
That's correct. Yep, that'll go through here.
All right. Well, great having you back. Thank you for coming back to speak to me again, Steve. And I'm a fan. And anything I could do to promote what you're doing, I will. It's a promise.
Well, thank you, Dan. Much appreciated.
All right, Steve. Everyone, thanks Steve Keen for being with us. Go to Patreon, visit it. Educate yourself about what kind of system we're living under, and if there is going to be a great reset, perhaps how it could change, and enjoy the rest of your day. Most of all, don't just count your pips, count your blessings. We'll see everyone for TGIF tomorrow. Thanks again, Steve Keen. See you, Warriors. See you, Eagles. Enjoy the rest of the day. See you in the private chat.
Okay, bye all.
Thank you, buddy.